Lennar, one of the biggest home builders in America, just reported a 36% drop in net income, and their gross margin collapsed to its worst level since the second half of 2007. The last time builders printed numbers like this, the housing market broke in half. Here is the 18-month buyer playbook. Check this out. On June 11th, 2026, the second largest home builder in America told Wall Street it had a good quarter. The stock actually climbed that day, but underneath the press release, the one number that matters had fallen off a cliff. Lennar's profit dropped 36% from a year ago, and the slice of every home sale the company actually keeps, what builders call gross margin, shrank to 15.6%. That is the thinnest that margin has been since 2009, the depths of the last housing crash. And here's the part nobody put on screen. Three other giant builders filed their numbers weeks before, and the same crack is sitting quietly in their footnotes. In the next few minutes, you are going to see the exact margin and incentive numbers four of the biggest builders just printed, the matching set from the last crash that ran in this same order. What this freeze is already doing to the people who swing the hammers, and where the work and the deals are quietly moving so you can get in front of it. When all four of the four biggest builders squeeze the same quarter at the same time, that is not a Lennar problem. So what is it, and where does it go from here? Go back to 2007. The man running Lennar back then, Stuart Miller, stopped talking about growth and started talking about converting homes into cash as fast as possible. That is the language a builder uses when orders break and it needs cash in the door before prices fall further. That year, Lennar lost $1.9 billion. Revenue fell 37%, and by the end of it, nearly a third of its buyers were walking away from contracts they had already signed. Here is why that reaches your front door, even if you never sell. When a builder dumps finished houses for cash, the price it accepts becomes the new comparable sale, the nearby sale an appraiser uses to value your home. So a builder cutting a deal 3 streets over just reset the number on your house, whether you wanted it or not. Now lay the current quarter side by side. Lennar, margin down to 15.6%, paying buyers incentives worth 12.9% of the price of the home. KB Home, revenue down 23%, margin already at 15.3%, and the company quietly cut about 10% of its own staff to match the slower pace. NVR, revenue down 22% and profit down 34%. Pulte Group, margin squeezed by more than 3 full percentage points, with incentives near 11% of the sale price, roughly $54,500 handed back on a $500,000 home. Every one of them is doing what Miller did in the last crash, paying buyers to show up and giving away the profit to keep the volume going. And thinner margins do not stay the builder's problem. They mean deeper price cuts next. And deeper cuts mean the comparable sale that sets your home's value keeps sliding. Now the fair other side, because the builders say the worst is behind them. Lennar trimmed incentives this quarter and guided its margin back towards 16%. It is sitting on $1.8 billion in cash with almost no debt, which is why the stock rose. They may be right for a quarter or two, but a 36% profit drop and a delivery target the company just quietly cut is not the bottom of a recovery. It looks more like the top of a slide still picking up speed. Hey, real quick, I put together a handful of courses that'll blow your mind. The Real Estate Crash Bundle and the Mortgage Master course. If you would like to learn how to take investing in real estate to the next level, or just buying your house and saving a ton of money, links down below. Now let's get back to the video. And when a builder's margin gets squeezed, the chief executive keeps his job. So whose paycheck is the first to go? And how many have already gone? Over the past year, building added almost no new jobs. 2025 was the worst year for construction hiring since 2011, when the industry was still digging out of the last crash. But that flat number hides a split. The big commercial side, the data centers and power plants and warehouses,
is still adding workers fast. It is the home building side that is bleeding. The crews that frame houses and pour foundations are getting cut, and construction unemployment has climbed back above the national rate. When a builder cancels a subdivision, the framing crew, the concrete sub, and the lumber yard lose the work, and so do the diner and the truck dealer down the road. The damage clusters exactly where the building was hottest, in the Sun Belt, where finished homes nobody bought are piling up around Austin, Tampa, and Jacksonville. Now, the honest counterpoint, because this is where a lot of channels overreach, some respected analysts say the giant layoff wave has not truly arrived. New home sales held in a range instead of collapsing, so builders kept most of their crews, and many trade workers do remodeling rather than new building. They are not wrong about the national headline, but the cuts are real and deep where building was hottest. Hiring has slowed to one of the weakest paces on record, and the backlog that kept crews busy is running down. The fight is no longer over whether the trades get hit. It is over whether the rest of your town is next. And this break is not a copy of 2007. Last time the collapse came from bad loans that blew up and dragged the trades down with a wave of foreclosures. This time, the houses are not blowing up. Buyers simply cannot clear today's prices at today's rates, and owners locked into cheap mortgages refuse to sell and give those rates up. Same frozen builder, completely different cause. You can see it in the foreclosure data. Filings are up 26% from a year ago, the highest in 6 years. And in places like Austin, new filings have more than doubled. But that is nowhere near 2007 levels, and it is driven by property taxes and soaring insurance bills in the Sun Belt, not a subprime meltdown. There is also a wild card the last crash never had. About a quarter of all construction workers and roughly a third of the skilled trades are foreign-born, concentrated in exactly these states. In Florida and Texas, roughly 4 in 10. Tighten immigration enforcement while demand is already falling and the trade gets squeezed from both ends at once. That 4-builder sequence is what the real estate crash bundle turns into an entry window, and Mortgage Master times a refinance once builders cut price. But you do not need either one to act on what is in front of you right now, because the sequence is reloading in the same order. Margins compress, incentives flood in, building slows, foreclosures ramp. Housing starts, the count of new homes builders break ground on, just fell to their lowest level in 6 years. Foreclosure filings are at a 6-year high and still climbing. It is bad, it is the same chain, and no rate cut is coming fast enough to stop it cold. The only difference between watching this and getting caught in it is reading those footnotes a few quarters early. So here is how you stand on the right side of this freeze, not underneath it. If you swing a hammer for a living, the danger of doing nothing is waiting on residential calls that are not coming back this year. The same data that shows home building bleeding shows the commercial and data center side booming. The framer who follows the work to the high-value build gets in front of the freeze. If you are a buyer, the danger of waiting is watching the best deals go to the people who lined up financing first. When Sunbelt builders are stuck on finished homes nobody bought, that is the exact moment the incentives and the rate buydowns get real. The prepared buyer with cash or a pre-approval sets the terms in that room, not the builder. And if you already own your home and just want to protect its value, stop watching the cheerful headline and start watching the early warning line. Builder margins and incentives show up in the filings first. Local permit and layoff counts move next. Unsold inventory and foreclosure maps after that. By the time the price reset reaches your street, it has been sitting in those 3 places for months. So go back to that press release, the one that said everything was fine and sent the stock higher. Everything that mattered was sitting in the footnotes underneath it, in the margin that quietly fell to a crash era low, and the delivery target that got cut without a headline. That same quiet is already in real towns now, in the crew that got smaller and the lot in Tampa that never broke ground. The builders are calling it a soft patch. The framer who lost his weeks knows better. And the footnotes are writing the warning a few quarters ahead of the headline, which means the only edge left is reading them before that quiet reaches your street and your paycheck too. Economic Ninja is out.